What's up, homies? Welcome to another episode of the Homies Real Estate Podcast. Here's your host, Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And together we're going to break down this crazy real estate podcast. We got a tremendous podcast that's going to really touch on the market conditions. We've been hearing a lot of talk about recessions. Is there going to be a house market crash? Will prices finally start to decrease? So Angel and I are going to review some data from Keeping Current Matters. They're a real estate firm that talks a lot about what the current market looks like with a lot of data. So if you're listening to this podcast on Spotify, on Apple Podcasts, you might want to tune into YouTube because we're going to be putting some charts. It'll make it easier to follow. So with that said, Angel, let's go ahead. Let's hop into the podcast. The first topic is, will a recession mean a house market crash?
Yeah, so I took this quote here from Keeping Current Matters, and it says, "We're not in a recession in this country, but if one is coming, it doesn't mean homes will lose value. History proves a recession doesn't equal a housing crisis." So if you come right here to this graph, it shows that in the last 6 recessions, only one, which is the one we're all accustomed to remembering, is 2008, right? That one is the only one that had a significant loss in home value, and actually only one other recession, which was in 1991, had a loss in home value, but less than 2%, right?
Yeah.
So a recession does not equal a housing crisis all the time, right? So, and we'll go into it in this podcast and show you signs that it doesn't seem like we're heading into at least a recession, yes, but not a housing crisis.
Yeah, absolutely. And I think a lot of us felt that pain from 2008, 2009, 2010, or at least had parents that felt that pain.
Yeah.
And because it was so recent, we feel like every recession is going to be just like that.
Yeah.
But that's not always the case. And the real estate market isn't always going to be like it happened in 2008 to 2012. Yeah. So, a couple of the reasons that this recession is different than what had happened in the 2006 crash is that, one, many purchasers were not truly qualified for the mortgage they obtained, which led to many more homes turning into foreclosures. And then number 2, a number of homeowners cashed in equity on their homes. And then when the prices dropped, they found themselves in an underwater situation where the home was worth less than the mortgage on the home. And many of these homeowners walked away from their homes, leading to foreclosures. And then that lowered neighborhood home values even more, right? And it's a lot different today. Today we have much more tight lending standards. And here's actually some data from the Urban Institute that shows how much more lending standards have tightened since the 2006 crash. And also, people are not using their homes like ATMs like they did in the early 2000s. A lot of people were taking out equity from their homes to purchase things. And now a lot of homeowners have so much equity. According to Homeowner Equity Insights, the average homeowner gained $53,000 in home equity over the past year alone. And according to Adam Data Services, 41.9% of all mortgaged homes have at least 50% equity. So you can see that people are in much better position than they were just 10, 15 years ago when the last crash happened. So that if there is some sort of market downturn and people lose 10, maybe 15% equity, they have much more equity to be able to lose, to be able to find themselves in an underwater situation. So it's a much different market than we had then.
Yeah, I mean, one thing I'll say to that is the reason everyone is gonna have that a recession, a negative connotation with the housing market is just recency bias, right? Like everyone's gonna go to the last recession that we had and put that and look at what happened then and not really look at the facts of it, right? Which the facts were that it had to do with, again, Anthony said, a lot of bad financing on these properties, and something that the government tightened up on and the lenders have tightened up on who and how people qualify for a home, right? Along with that, it's just like now we're coming into a market. It's funny, going back to that recency biases. We're seeing products that were similar to where back then, right? Like some interest only products are becoming more popular. Adjustable rate mortgages are becoming more popular. So those products that were similar then, during those times are kind of making their way back. And they have a very negative connotation. You talk to a client about an adjustable rate mortgage and they're saying, stay away. I don't want anything to do with that. Which I get it, because to me, when I first came to business, that was my thing too. I was like, oh, those are terrible loans. And that was all because of what people have experienced with them in the past, right?
Yes.
Not saying that they're the best loans, but sometimes those are the loans that actually may help you right now get into a house.
Yeah, absolutely, Angel. That's a great point there. The second topic that we're going to talk about is, will home prices fall? Right? And we're talking about the inventory of homes. And it's nothing like we saw during the 2007, 2008, 2009, 2010 period. So for those of you that don't know, inventory month supply means if there was no more homes listed, it would take X amount of time for the current homes on the market to be sold. And during 2007, that was 7.4 months. During 2008, 9.8 months. During 2009, 9.6 months. And in 2010, 8.3 months. Right now, that as of 2022 sits at 2 months. So if there was no more homes listed, it would just take 2 months for the current homes on the market to be sold. And in Los Angeles County, that's even faster, 1.5 months. And then homes in Los Angeles County are selling faster than ever, 9 median days on market. So that really shows you what the demand versus supply looks like in the United States, and then especially Los Angeles County. And yes, you may hear that in different regions of the United States, the market is starting to slow down, but it doesn't apply to everywhere, right? It doesn't apply to Los Angeles County because homes are selling as fast as they've ever sold, and home price appreciation is as strong as it's ever been the last couple months. So you just want to make sure that you're cautious about making predictions that there's going to be a whole much more supply and that it's going to flip into a buyer's market, just because it's not like it was in 2007 to 2010. There's just so much more demand than there is the current supply of homes. So it's just something to be aware of. Is there anything that you wanted to touch on for that, Angel?
No, I think you brought up a lot of amazing points on that. That was good.
Okay, sounds good. Go ahead and touch on the next topic, Angel. If we're in a housing bubble.
Yeah, great question. So everyone keeps mentioning we're in a housing bubble, but the truth of the matter is that compared to last recession, there's a lot of more new construction single family homes coming onto the market. Again, we talked on the lending standards were a lot loose back then, and then many homeowners again were cashing out much more money than what their home was worth, right? And now we're in the opposite, where we don't have enough inventory, we don't have enough new construction coming in, right, to help the housing deficit that we're in. The market again is undersupplied, and then we have too much supply and demand, right? The lending standards are a lot more tighter than they were back then, and then much more homeowners are a lot more cautious about how much money they want to take out. Along with how Anthony mentioned earlier, is there's a lot more equity on these properties available to take out if they did want to take out money.
Yes, absolutely, Angel. So I hope, this gives you a pretty good idea of, the housing bubble that's supposed to come, because we can't guarantee that home prices are going to continue to appreciate, and we can't guarantee that there's going to be a housing market crash. All we can look at is the data, and the data suggests that we're in a really healthy real estate market, and prices are going to continue to stay steady or even increase just because of the current demand versus the supply.
Exactly.
Yeah. So let's take a look at foreclosures. Are there going to be a lot of foreclosures coming? This is something that we've heard about. And the fact is, we've actually seen less foreclosures in the last 2 years than we saw from 2017 to 2019, which is very, very surprising. In 2017 to 2019, we're looking at anywhere between 315,000 to 277,000 foreclosures, right? And an average of 290,000 foreclosures. And then from 2020 to 2021, we saw, 129,000 foreclosures in 2020, and then 38,000 foreclosures in 2021. 2021. So I know a lot of people are expecting foreclosures to come, but again, it's a much different time than it was last time around because homeowners have so much equity. Home prices have appreciated 20-30% in the last 2 years. So there isn't anyone that's really underwater on their property that needs to sell and get off of their property as soon as possible. If anyone's going to sell, they're going to try to sell for top dollar because they have equity and they want to walk away with as much as possible. Right? So that's just something that you need to consider. Another thing is, again, there's so much demand for homes that any foreclosures, any homes that hit the market is just going to be absorbed easily, and people are going to pay market value just because there needs to be, again, 5+ million more homes to satisfy our current demand. And we're not going to see those homes with these foreclosures, especially if we're averaging, 300,000 foreclosures a year. It's going to take a lot of foreclosures to get us out of that hole. So it's just something to keep in mind that a foreclosure crisis will not correct the market. And no, we don't expect to see a tremendous amount of foreclosures hitting the market in the first place because of the equity positions that many homeowners find themselves in. Yeah,
no, Anthony hit it right on the spot. I mean, we're hearing that a lot. Oh, foreclosures are coming. Unfortunately, it doesn't look like that. So, but yeah, I think Anthony you touched really good on it. So the third topic we're going to be hitting on is, housing prices will depreciate, right? A lot of people are sitting on the sidelines thinking home prices are going to go down. Home prices have to go down, right? Instead, based on the forecast from various experts, including Fannie Mae and Freddie Mac and Mortgage Bankers Association, they're forecasting at least a 9% increase in home prices this year, right? So that's a lot. That's more than what I was anticipating, or I'm anticipating this year. I'm thinking more about 5 to 6% it will increase. But already, I think the first half of the year, excuse me, has proven us wrong as far as when we're doing the market updates every week. They continue to increase every month more than we were expecting, right? So it's very interesting to see what's going to happen. Again, the rates have continued to increase. They've actually been steady over the last 2 weeks, which has been good for us. But yeah, rates have gone up significantly since the beginning of the year, and that has seemed to not have a huge impact on homes appreciating, right? It's funny though, homes are sitting on the market a little longer now. I think people are there's less offers coming in on homes, but the fact is that if a home's priced correctly and it's appealing to many buyers, it's going to attract the attention to get well above the asking price, right? So, or the listing price, I should say. But yeah, it's going to be interesting to see if it's if we hit that 9%. I don't know if we'll get to that, but I wouldn't doubt it, again, based on how appreciation has gone, and we haven't even hit the summer months yet.
Yeah, absolutely. I would say, Angel, I'll correct you. Homes are selling still 9 million days on market as fast as we've ever seen. But the data for May will be coming out soon. Yeah. And when the data for May comes out, chances are homes are going to be staying on the market a slightly tad bit longer, maybe 10, 11 days, which is still incredibly fast considering from 2017 to 2019, homes are sitting on the market 40 plus days. So, comparatively, it's really, really fast.
Exactly.
But yeah, it's crazy to see the appreciation that we've seen the first half of the year, considering interest rates have increased 2+%
over the last year.
Yeah.
It's crazy.
My guess is that a good chunk of the appreciation is going to happen in the first half of the year. So from January to June, we'll likely see that 9% appreciation bump or 10% appreciation bump, and then it'll likely kind of plateau out, and we'll stay along those lines for the remainder of the year. Is what my guess is. Again, if interest rates continue to increase dramatically, then that might slow it down a little bit more. But I think kind of like what happened in 2021, a good chunk of the appreciation for a lot of homes came in the first half of the year. I think it's going to happen again for 2022. I think it's going to start to plateau sometime at the latter part of this year, maybe late summer, where prices start to finally mellow out a little bit, and then we end the year nationally somewhere along the lines of 9 to 10% year over year appreciation. Again, Los Angeles County, Southern California, different market. It's more competitive here. That'll probably end tad bit more, maybe 12%, maybe 13%, so a couple percentage points higher year over year. But nonetheless, it looks like prices will continue to increase as long as we stay under, 8% interest rates, like that's something drastic like that.
And one topic I do want to touch on real quick that we didn't have outlined in this podcast is what interest rates do during a recession, right? I think people don't realize, rates have gone up significantly, but historically speaking, when we are in a recession, interest rates decrease, right? They come back down. That's my projection. My projection is by the end of the year, interest rates will come back down. I don't know if we'll be back in the 2s, but I'm thinking somewhere in the mid 3s is what I'm assuming. But it's definitely going to be down from where they are right now, is my opinion. I have a strong belief in that. And history shows when we are in a recession, the Federal Reserve lowers interest rates, of course, to stimulate the economy, right?
Yeah.
So that's something to keep in mind.
Yeah, absolutely. So that will happen. But again, after we get through the inflation,
of course.
So we have to keep the interest rates high until inflation cools down. Once inflation cools down, then we'll likely see interest rates drop back down to help stimulate the economy. And then that's
a never-ending cycle.
Yeah, exactly. And then that's when you'll likely see home prices increase in value a lot because everyone's qualified for more. So I think this gives you homies a pretty good idea of what the current real estate market looks like. Now, you're going to hear a lot of headlines about a real estate market crash, about a recession that's coming. And you want to make sure that you're armed with the best education. So I highly recommend, if you're not following Keeping Current Matters on Instagram, to follow them, because they post a lot of educational things that are facts, that it's all data that you can interpret on your own. And then also beware that national data or data from other states doesn't always apply to Southern California, because we're a whole other animal. It's more competitive here, and there's no doubt about that. So just because maybe home prices in Texas or in Arizona are dropping doesn't mean that it's going to start dropping here in California. So you want to make sure that you're also following the current local real estate market, which is why if you're not already subscribed to Be a Homie, please subscribe to Be a Homie. You can find the link in the bio.
Next week, market update, so you'll get a really good idea what LA and Orange County are doing.
Absolutely, yes. But yeah, subscribe to Be a Homie. I'll send you, or our team will send you, custom market updates for any city, county in California, from San Francisco down to San Diego. And it's super insightful. We tell you how much home prices have increased since the last month, in the past 12 months, and how fast homes are selling. And then also, once in a while, we'll throw in the appreciation rate for the last 5 years, so you know how much homes have increased in value, appreciation, or I guess percentage wise. So, with that said, homies, let's follow Angel, Angel, where can we find you at?
Your Mortgage Angel on Instagram.
At Your Mortgage Angel on Instagram. You know where to find us, at the Luevanos Group. And with that said, I do want to wish you all the best, homies. Take care and stay safe.
Thank you. Hey, homies, it's Angel from the Homies Real Estate Podcast. This podcast contains our opinions and is for educational purposes only. It does not guarantee any projections and should not serve as the basis for any purchase or sale in real estate.